Welcome to another episode of Exploring Prosperity. In this week's episode, I'm reposting a portion of my earlier roundtable with Lyn Alden, Bob Murphy, and Troy Cross. A discussion about what our world might look like if the U.S. had reconnected the dollar to gold back in 1971. I wanted to bring this one back for two reasons. First, gold's price hit an all-time high this week of $4,393, up a shocking 30.0% in 56 days. The prior record was up 30% in 90 days, and that was set 46 years ago in 1979. So it's worth revisiting now how gold connects to living standards and the idea of hard money. And the second reason I want to post this clip from March is that Saifedean Ammous, author of The Bitcoin Standard, just announced on X this week that his new book, The Gold Standard, will be available for purchase on November 14th. And I'm guessing it'll explore many of the same questions we tackled here, but it'll be done in his extremely comprehensive style. In this clip, we dig into how sound money might change investment, innovation, and wealth distribution, how fiat money has distorted price signals and weakened real market discovery. Lyn Alden explains how easy money fuels debt and financial arbitrage, and Bob Murphy shows that even under deflation, investment and growth would still thrive. And Troy Cross highlights how fiat's pricing distortions mask true demand and accurate production. It's a powerful conversation about what might have been and what could still be if sound money ever were to make a comeback. Now on to the clip.
You're also saying that if I save my money in a gold or a Bitcoin that holds its value, then that is a competitor for my ability to invest or lend, and that might constrain economic growth?
It could constrain malinvestment. It could also constrain growth, right? Where's the point where turning down the money supply sort of maximizes, curbing malinvestment, but it doesn't like shut down the economy? You get, some of the things that Michael Saylor says, I kind of laugh at, like where he's just telling everybody to stop trying to work and do anything productive when they could just be buying Bitcoin. He's like, don't try to compete with Apple, Google, Facebook, Meta. Just buy Bitcoin. And is part of my mind saying, wait a minute, okay, it's logical given the price of Bitcoin, but if everybody did that, there would be no economy, and that would not be good. Like if we all put our money into this non-productive asset, then who is making productive investments if the hurdle rate is like extremely high, right? So yeah, it seems like on the one hand, malinvestment on one side of the spectrum, on the other side, underinvestment. And well, I'm sure that there's some central bankers out there that think that they know where that equilibrium point is, and they're trying to target it.
Bob, this is a subject that you know well, isn't it?
Yeah, because I don't know if Lyn wanted to answer, but yeah, I'll chime in, and I'm curious, Lyn, too, your thoughts. But it's just ironic, literally. So we're recording this, folks, on March 17th, but on March 14th of 2025, you're listening to this later on. I had my episode of the Human Action podcast was precisely as, I think the title was, "Will Deflation Stifle Investment?" Because people were emailing me, and it's a typical question, like people who are skeptical of Bitcoin, or if they like Bitcoin, but this is a nagging concern. And you're right that if price inflation's like, suppose the real rate of interest is supposed to be 2%, and then yeah, if prices are falling 1% a year, that's fine. Then the nominal interest rate can be 1%. But if prices are falling 5% a year, well, then the nominal interest rate can't be negative 3% because everyone just holds cash and they earn zero, right? And so the way I handled that was a twofold thing, just in terms of could investments still happen? And I just walked through an example saying, like a bottle of wine that's a year old, like right now it sells for $100. Let's say that next year it would sell for $95. And so you say, why would anyone invest in making that? Well, if the glass and the grapes and everything else you need only right now cost you $94, then you still could, right? So it's, even if the bottle, a given bottle of wine of same quality and age drops 5% a year, and even if, workers' wages drop 5% and the price of grapes drops 5%, all of that is consistent with you spend $94 today to then sell it for a product that sells for $95 a year from now. So you could still, So there's that element. But then you're right. If you say, okay, but in terms of just general loans of money and whatnot, where it's not tied to a product, And I think you anticipated my answer, Troy and Bob, that I would say, right, I think it's actually a feature, not a bug, that in general, a household that just wants to defer consumption. They want to live below their means now, maybe because they're saving for their kid going to school or retirement or whatever. It's not that they have a particular opinion on, oh, I think the NASDAQ's going to outperform over the next 12 quarters. Like, no, it's just, I want to save for the future. What's the most generic thing you can save in is the money that your community uses. Right now, we've been trained, people in our age to think that's nutty. Like, oh, you're putting $100 bills under a mattress. What are you, insane? Inflation's going to kill. But that's because of, the dollar loses value. Back, in the 1800s, putting gold coins in a piggy bank wouldn't be a dumb thing to do. And so I think that's actually good. That you don't need to worry that there's going to be factories and coal mines that are permanently underutilized because, oh, shoot, everybody's hoarding cash. Like, no, prices would just adjust to get them back into usage. So I think that's actually a good thing if you restrict the control over society's scarce factors of production to those people who actually have some expertise in their professional investors, rather than just the general household has to invest in the stock market so that inflation doesn't kill you.
Yeah, sample size is always challenging with this when we look at, say, historical examples, because we can talk about the theory, what would happen, and also, what examples do we have from history of what happened in practice. So, for example, the Renaissance in Europe occurred at a time of kind of historically sound money, the gold florin, which went, undebased for quite a while. And then the 1800s in the US, I mean, they had a lot of other advantages, basically an untapped continent and the discovery of like hydrocarbons at scale. But still, that was a period of relatively sound money and yet booming economic growth. But a lot of that is, you can say, well, it happened to occur with a good tech mix that happened, like a big breakthrough in tech, like hydrocarbons or printing press and things like that. A point that I generally make is that, and I get the similar emails that Bob mentioned of people saying, hey, what about deflation? Deflationary money, how would that impact investment and lending? And that's where, one, I tend to draw the line not just at the deflation level itself, but at the actual line of money supply growth relative to typical resource growth. And that's kind of the cutoff point that I think is perhaps more relevant in that discussion, because that's the cutoff point between two very different types of debt. There's like high ROI debt that's kind of out of necessity, and then there's like debt for arbitrage. So one of the points I made before is that Procter and Gamble's like the century-old company, and it's like, why do they have $40 billion in debt if they've been profitable every year longer than I've been alive? Why do they have debt? And it's actually Procter and Gamble selling bonds is like their highest. That's like their best thing they sell.
This show is being brought to you by our sponsor, Trueflation. Professional investors and economists and probably any casual observers know that government inflation statistics are only an approximation of what real inflation is. Not only that, but the government has a conflict of interest because high inflation can be so damaging to the economy, the deficit, and our $36 trillion in debt. Trueflation collects over 80 million pricing data points. Most are updated daily to reveal inflation with precision for asset managers, governments, companies, and the general public. Check them out at trueflation.com.
They sold these like 2% 20-year bonds and against their collateral. And so they have a structural short on fiat currency while they otherwise run a reasonable business. And that's big corporations have had massive arbitrage because of that. And that only works in an environment where, say, money supply is growing at like 7%. And you're willing to tell people, hey, inflation's 2 or 3%, so maybe you got to get 2 or 3% yields to protect yourself. And Procter & Gamble goes out and says, well, we can sell lots of those bonds then. And so the people that are kind of holding those bonds are kind of getting gradually diluted away, whereas if you're the one selling or shorting, that you're doing quite well. So I think that in that environment where you get to more a gold-like or a Bitcoin-like type of where the underlying money is sound, there's no technological mismatch that kind of pulls people toward faster but maybe more debasing monies, then having a 30-year mortgage, like I have a mortgage I don't need right now. It's kind of like Procter & Gamble selling bonds. If that was denominated in Bitcoin or gold, I would pay that off tomorrow. And so, but I purposely don't, because I'm kind of arbitraging what fiat currency is offering me to do. And so all sorts of these like structural, like purposeful kind of permanent debts. So massive rolling government debts, massive kind of corporate permanent fiat currency shorts, the incentive to have 30-year debt tied to things and then go stash your other money in the stock market while you have that mortgage. That's this kind of all incentivized by the current environment. Whereas if you had a harder money and there's still be like a need for, hey, there's a lack of plumbers in this town. Any plumber that comes along is going to have a really high ROI. So it makes sense for him or her to borrow like a year's worth of supplies and initial equipment, even under a relatively hard money standard. And it makes sense for someone to say, well, I'm happy to buy give you some equity capital because I think you're going to outperform, or I'm happy to lend to you because I think it's pretty safe investment to get a kind of a moderate rate of return, and that'll do quite well. Same thing for someone trying to learn a trade. They have no income, and then they say, well, if I can spend a year or two to learn this thing, and then I can become a plumber, become an electrician, and things like that. So I think that both historically and then in theory, sound money shouldn't really be a stopgap against responsible investing, and it mostly takes off that kind of arbitrage aspect, which is something I would argue like 2/3 of our existing debt out there, if not higher, is that type of arbitrage debt rather than that type of, say, business loan, like short-term business loan, collateralized lending. That's a much smaller component of all existing debt.
We're proud to be sponsored by Foundation. They've created Passport, one of the top-rated Bitcoin hardware wallets, proudly made in the USA. It's fully open source and air-gapped, meaning your Bitcoin stays completely offline and secure. The shocking Bybit exchange hack shows why holding some Bitcoin offline diversifies risk. Now they're launching Passport Prime, your all-in-one solution for not only Bitcoin, but all passwords and 2FA security. Head to foundation.xyz to secure your digital future.
There's a little case that occurs to me, which is has occurred to me multiple times, which is like sometimes malinvestment pays off. Like you have you suppose you have all this money floating around in the system, and maybe you maybe you lend it to Procter and Gamble, and then Procter and Gamble does something really cool that they wouldn't have otherwise been able to do, and then everyone benefits. And since we've been through these like technological leaps, I look at I look at the internet bubble, let's say, in the NASDAQ bubble, massive speculative frenzy. Some of those companies paid off, like Amazon. I shorted Amazon back in the day. It turned out to be like a very successful company, a very bad short. I was in graduate school at the time. I was like, this is insane, insanely overvalued. So, but you know what I mean? You as a generalization, you're going to get less malinvestment when people have this alternative, this hurdle rate of just money, just stuffing dollars under the mattress if they're linked to gold or whatever. But the way technology works, sometimes you, through malinvestment, just so happen to fund something that explodes in value, even though it wasn't necessarily rational, or you wouldn't have been doing it in a time of penny pinching, but you made this investment in, let's say, Amazon, and then boom, it changes the way we buy and sell things and brings a tremendous amount of benefit to everyone. Or just think about like the DoD budget, which funded so much of academia, so much of general basic science, and set the U.S. on a path to world domination. It's probably malinvestment, but it was malinvestment that actually worked out. That's not in any way a rejection to anything you're saying. It's just like a rider, But so 1971, like maybe we had less malinvestment, but maybe we also wouldn't have. Maybe we also wouldn't have had other things that we now take for granted, because we would have missed a technological possibility that encouraging that investment allowed us to find.
I've always thought that the mal in malinvestment was referring to the portion of excess investment that didn't work out, and that it would be hard to assume that investments in good ideas that ultimately were successful would not get funded under a hard money standard. Some might not, but I don't think the evidence of our technological advancement over the last at least 275 years anyway would suggest that those good ideas would not have gotten.
Yeah, well, we just never know what a good idea is until the market shows us, right? And so some of the things we think are long shots actually pay off, and most of them do not.
No doubt about it.
So it's just like we tend to be a heavy, risk-heavy, investment-heavy society, part because the money is so easy. And I'm just pointing out that at a moment where you're in like a technological moonshot, that might just by accident work out. Not recommending it as a policy.
Bob, Lyn, what do you think about the fact that we've had much more investment than we would have being the component of our success?
Sure. So just to comment on two things. So Troy also had said like 10 minutes ago at this point, something like, when if inflation's in one society is 2% tends to be 2%, meaning consumer price inflation, and another when it's 7%, wouldn't just nominal interest rates be 5 points higher? And so, and I think that's right if it were predictable, right? So with a lot of this stuff, it's not so much just what is the mean of the inflation rate, but also the standard deviation, right? So if there were a cryptocurrency that had it just, quantitatively every week it grew at a certain percentage such that it grew at, 16.2% annually, that with mathematical certainty, I could see if the world moved to that as a standard. For some reason it outperformed Bitcoin, people liked it better. Things could adjust, and if it outperformed other possible currencies on other metrics, the fact that it constantly grew at 16.2% annually wouldn't be a deal breaker for me. I think everyone would adjust to that. But it's more, like I said, it's not just that societies that tend to have high price inflation, that the mean is high, but it's also the volatility, so you can't even just compensate. So there's that element. As far as your more recent, I understand the point you're making. Let me just be a bit flippant and do a reductio ad absurdum. This is somewhat unfair to you, but we could also say, why don't we just go through and look at, the names of all the people who apply, and then every week we'll just flip a coin, and then anyone, whose name started with F, he gets funded. And then next week, anyone whose name, Xavier, it's your shot. And it is conceivable that approach, would fund something that would otherwise have not gotten funded according to other criteria. So yeah, you can always do that. I think the idea is just to say, okay, but we got to do the best we can, and to under a hard money standard, I think people just have a much better sense of what's sound and what isn't. And also too, in general, if society's wealthier and they can, if more of your portfolio is in things that are very solid, that gives you the freedom, the leeway to do long shot investments where you just have a better sense of it. I think there's this perverse thing with the current situation where everybody has to have a medium amount of risk in everything just to make sure there's something there when I retire. And I think that paradoxically makes firms and households not have enough left over to allocate to things that, like, oh yeah, you want to go set up a moon base and and mine asteroids and things, and there's a 1% chance that's going to pay off 600,000%. Well, right now we can't do that. We can't afford it. But maybe in the kind of world that I sketched in the beginning, there would be some people who would have the ability to fund that kind of a genuine long shot.
One of the points I like to make is that the dot-com bubble occurred actually during a time of, by U.S. standards, or 20th century standards, relatively sound money, which is to say that broad money supply in the U.S. in the 90s was growing very slowly. And we had kind of peak demographics because the baby boomers were in their kind of peak productivity years. And they had already gone past their initial home buying years, which is a source of a lot of credit creation back in the 70s and 80s. And so the 90s actually had relatively low money supply growth, relatively slow rate of debasement by most metrics. It wasn't debt fueled, it was equity fueled for the most part. And that type of euphoria was basically, I would say, not associated with weak money. It was more associated with, we hit kind of a technical milestone, which for the most part rationally got a lot of people excited, and then they overdid it. But the things they dreamed about in the next 20 years essentially came true, just with a lag. And not always the same companies they bet on, but that all structurally was directionally correct. And there were similar activities back in when they found oil, and they said, well, instead of whale oil or coal or wood, we have this other, we have these other things we can do now. Um, and when you put together aluminum and hydrocarbons, you open up air transport at speed, right? It's not really, it's like you can try for centuries and get absolutely nowhere on air travel except for like Zeppelins. And then finally, you have the two missing components you needed, and suddenly there can be a speculative fervor around that. Even going back to the post-Renaissance or the Renaissance or post-Renaissance, all these crazy people that like got on ships, like wooden ships with like no radios, like no safety, like no like safety boats. They're like getting on these wooden ships and just like going across the ocean because they think it's a high return on investment. And there's a lot of death, but then some of them were right, usually not in a very ethical sense because you go and take someone else's treasure. But that was essentially another one of those like technological arbitrages, which is basically when sea navigation and these other things kind of all came together. There are a lot of people that would finance these endeavors, despite the fact that money was relatively sound at that time, both kind of relative to the period before and after it. And so I think that when an opportunity presents itself, even under periods of sound money, from what we know in history, people will still get excited. People will still invest. And I'm even like I work in Bitcoin venture, despite the fact that Bitcoin is a really high hurdle rate. And to Troy's earlier point, where like I think Michael Saylor emphasis on just buying Bitcoin and what would happen if everyone did it. I think that it's a point where in this period of time where if you're bullish on Bitcoin, you think the total addressable market is whatever it is, it's well north of here. And so Bitcoin's going through this adoption phase where it's getting closer to a total addressable market. So the return on investment can be kind of crazy. But that if everyone did it, it would already be kind of closer to its total addressable market. The return would be lower, and it would then behoove you to then say, well, instead of just holding Bitcoin, I probably should deploy this in ways that rationally can give me higher ROI. So I think a lot of that works itself out. And there are brief periods of technological disruptions or new things or new monies that kind of make the equations a little bit briefly interesting, but that it tends to settle.
To what extent has this fiat money system since 1971 contributed to one of the biggest political complaints in the U.S., which is the wealth gap and the income gap between the haves and the have-nots?
Sure. So I'll chime on that. Yeah, that's one of my points, Bob, is so for those who may have seen these arguments, it's standard like left-leaning think tanks in the United States, like I think they call it Economic Policy Institute, or EPI is one of them, but there's other ones too. They'll release charts showing like, oh, look at inequality, was very high in the 20s, and then it came down, and then it was dropping through the 50s and 60s, and then all of a sudden, when Reagan comes in and there's all these tax cuts and deregulation, and look at it, and they show the turn. But what I know, and then a lot of my colleagues that I'm a free market economist, so a lot of my buddies would go in and attack the statistics and say, oh, well, these figures, showing that the compensation to the top 1% outperformed and blah, blah. They leave out, non-monetary benefits and, other things like this. And they would go and quibble with the statistics. Whereas my response is I'm looking at the very chart that the EPI put out, and the bottom out point happens it happens in 73. Right? It's like, no, Ronald Reagan wasn't doing tax cuts in 73. Like that was the recession that happened right after Nixon goes off gold, right? So I just went through and just showed how all of the charts and whatever that these groups were putting forward to show the evils of tax cuts and how that's handing money over to the, the fat cats, the top 1%. Actually, their own stuff showed that trend completely turned around for whatever reason, but it was, in the late 60s, early 70s. So yes. And then, ex post theoretically, how could I explain that? Kind of what I was getting at in my opening remarks, that I think when there's, boatloads of money that come in periodically, like who's making a bunch of money, during all QE and all that stuff. It's not the guy who works at a factory. He's not able to all of a sudden go to his boss and say, hey, I want to, but the people who, speculators dealing with Wall Street and who anticipate money flows and can get into a different portfolio because they respond 10 minutes before somebody else does. Those are the people that can make huge outsized returns in a very uncertain environment where the Federal Reserve can just snap their fingers and create $300 billion in a day, right? So that is the kind of environment where clearly I think the 1% are going to get ahead relative to other people.
Yeah, I think there's two different types of kind of wealth concentration. There's kind of the better kind and the worst kind. The better kind is when everybody's getting better off. because innovations are happening. And so, for example, like let's say the Gilded Age, obviously there were issues with it, but if someone is getting rich because they're the ones that are, getting the financiers and the workers together to build the railroads, and or someone else is like inventing electricity as some sort of you know it's economically efficient, or figuring out how to make the automobile, the assembly line, and kind of putting all the right pieces together and operating a business. If they're increasing their wealth quite a bit, but then it's also everyone else is living longer than they were 10, 20 years ago, they're materially better off as well. That's like an innovation based sort of wealth concentration that can occur. Whereas in the current era, we have more of a financialization, which is to say that it's generally more lucrative to go to Wall Street than be a inventor or a business person, unless you're kind of the breakout success there. Like if you just play the odds. And we're also in an environment with high wealth concentration, but especially in America, a lot of the statistics look equal or worse than a decade ago or 2 decades ago for a lot of people, which is to say that we're in this kind of weird period where life expectancy is actually going down a little bit. There is more deaths of despair from addiction-related things, and people kind of rightly feel like they're treading water or even kind of going backwards, despite maybe having a double-income household and kind of racking up debt and having all these issues. And that's because it's a different type of wealth. The wealth concentration is more directly tied to my prior point around financial arbitrage. That if you're a big entity, you can issue 2% bonds, and you can play all the games. Whereas if you're on the other side of that, you're the one that's getting diluted, that's always trying to keep up. And so I do think that in the current era, this money situation does contribute to wealth concentration. But it's not necessarily to say that there wouldn't also be periods of wealth concentration under sound money. It just generally would be a less destructive type of wealth concentration, one that's a little bit more rational and innovation based, rather than this kind of arbitrage based.
Yeah, Warren Buffett actually wrote an op-ed about 10 years ago that hit on this, and it was very interesting. He said you will get more billionaires as the economy progresses naturally, if it's doing it in a healthy way.
Yeah, I just want to add a brief thought, because I agree with what Bob and Lyn said. Bob's original point about the increasing financialization means that if you don't have the means to avail yourself of financial expertise, then you're going to be on the wrong side of all of these bets. And generally, most people do not have the money to avail themselves of these services. And the people who are most savvy in this realm are people who are already very well off and can afford the expertise, or they have morphed into one themselves. So, yeah, I think, I see it very, very up close and personal with my students who enter a world where wages are not substantially higher, or in some cases lower, than they were 20 years ago, where housing is very high, where assets are very high. And I attribute all of those things to, in part, an expanding money supply. It allows employers to keep wages low while giving nominal raises, and psychologically, massaging the workers into being satisfied, gives them a little negotiation edge. In the long run, that should not hold true, but human beings have a really hard time discounting that inflation. And also it makes assets more expensive. Wealth does flee to real estate. It does flee to things that people actually need. And it's depressing to see that unfold. I had a student many years ago. This was before I got into Bitcoin. It's one of the reasons I got into Bitcoin. Very successful student at a very fancy university said to me, well, there's only two ways to get wealthy in the world. And one of them is to, be Bill Gates and make a company that everybody uses. It's like what Lyn was saying, create wealth by creating valuable goods and services for other people. That's really hard. That takes a lot of work. The other is just to go to Wall Street. And I was just a kid from rural Michigan at that point, and I was like, "What? Like what? That doesn't sound right. That doesn't sound like the way the world should be. That those are your two options." I understand the first one. I don't really understand the second one. But she was right. And not long after that, the financial system blew up in the 2008 collapse. Right, and then I saw that not only was she right, and that easy money has kind of created this large sector of the economy that pays very handsomely, but also we're all on the hook for it in case it ever fails, so that the risks are borne by everybody, but the upside is borne by the few who are in it, right? So yeah, I think financial services as an industry also just contributes to inequality sort of directly. But yeah, I agree with both of you.
On one of the reasons that fiat works in favor of governments and hard money works to the favor of individual liberty is the size of government can grow. And with the size of government, you wind up with something that you don't see very much in the U.S. economy, but is probably there. And I'm curious how much you think is there, and that's simple price discovery. What would be the real prices of goods, services, and money if there was a hard money standard, and how far off would it be from what we see today?
Can you? I'm not sure I understand the question. Can you elaborate on that?
Well, the size of government gets in the way of the efficient functioning of the economy, and in particularly with the Federal Reserve setting the price of short-term money, that will have an impact on the price of money across the board. But the government as a customer also impacts money. The government as a provider of resources impacts price discovery of the items that are purchased through the economy. Is this something that's a big impact from hard money? If hard money had been around, how big would the government be, do you think? And would that make a big difference on pricing efficiency?
Okay, yeah, sure. So I can certainly speak to that. This circles back to, I don't know if you guys saw, but Elon Musk recently, I mean, he gets in 18 fights a day now on social media, but somebody had come out with something, I think it was the Atlanta Fed Now's estimate for GDP in the first quarter, in the course of like 2 or 3 weeks, went from being positive to being negative. And so people were attributing it to the tariffs and things like that, but also saying, and all these Doge cuts, GDP or government spending is a part of GDP. You cut that, what do you think is going to happen? And then he was making the case that he thought it didn't belong. And I agree with that idea, at least conceptually, that, as economists, and here I'm not like being anti-government. I'm just saying, like, in terms of neutral, in terms of the science behind it, the reason you treat different, if one household spends $1,000 on electronics, another spends $1,000 on pizza, those both contribute equally to GDP. Because the idea is, well, the households, they could have spent their money however they wanted, subjective value, and, what other metric are you going to use? But if the government spends $1,000 paying somebody to do something, the conceptual footing for that really isn't the same, because those government officials, if they refrain from that expenditure, it's not that they could have then gone and spent $1,000 on something they wanted. That would have been construed as them stealing from the government, right? So, and that's, famously like Defense Department appropriations and things, you get, crazy price tags on stuff. So there's systematic reasons for why that is. So I think in general, that's true. And just to give one example, at the end of World War II, I think from going from 45 to 46, nominal GDP went down slightly, but private sector GDP rose by like 46%. And I think just private investment spending went up like 167%, something like that. And I just did an episode on this a couple of weeks ago. That's why the numbers are fairly at my fingertips. And that was officially labeled a recession, that period, right? And so typically in a recession, private investment spending doesn't go up 167%, right? So I think just showing the mismatch. So to your question, Bob, I think, yes, in general, as the government now is such a large share of the economy, a lot of certainly official statistics are very misleading. And and then in terms of, like, when people say, what should the interest rate be right now, we really have no idea. Because there's so many government distortions at various levels, and then the Fed doing what it's doing, I really, don't know. And so it's when the Fed either raises or lowers interest rates, and people might ask me like, oh, do you agree with that? And to me, that's a bit like, the days of the Soviet Union if they increase wheat production and saying, is that a good thing or a bit, we really don't know. Like you can't centrally plan an economy. We wouldn't have a bunch of experts picking the price of oil, but yet to have a bunch of experts picking the interest rate for some reason seems normal to us now. So I don't know if I'm answering your question, but yeah, I definitely agree. A lot of the numbers, even if they try to do them, quote, correctly, are kind of unmoored from reality at this point, given, government distortion.
Yeah, I think so. Weak money or government printed money does have an incentive and allowance for governments to get bigger with kind of fewer near-term risks to them. I mean, if they're operating on a sound money standard, they're at higher risk of nominal default if they mismanage their finances. Whereas when they control the ledger, they have a much longer runway. And the challenge there is that, in theory, you could have an extremely competent leader, like an outlier leader that knows really good ways to do resources, and then the end result is, well, in that country maybe it wasn't so bad because they're kind of taxes and spending are transparent, whereas debasement is kind of not transparent. But if you happen to be the outlier capital allocator running it all, maybe it works out. The problem is that most people are not going to be lucky enough to live in the place with the outlier capital allocator philosopher king that's doing that. An example that I like to point to is Egypt, which is for the past 10 years or so, especially I like this metric for developing countries. Their energy use per capita has gone flat to down from a fairly low level over the past 10 years, which is generally not a very good sign of per capita economic growth. If anything, you're kind of going backwards. And if you ask people how many hours of work does it take you to afford a car, it's not going in the right direction, with the exception of Chinese cars entering the market, and therefore basically, technological productivity is helping to offset some of that. But if you look at where the money's going, I mean, they built like a $40 billion new capital, Ghost City, and there's not much economic use coming from it, but there was a lot of resources and debasement that went into it. At the same time, they also went and they built like a nuclear power because they have all these power shortages. They go and build a really big nuclear plant, which I would argue is a good view, use of resources. But the problem is they did it out of order. So they go build the Ghost City. 10 years later, the average citizen is not really benefiting from it. Then they start the nuclear project, which of course takes a while. It's not online yet while the people having power issues. If they had done it in reverse order, it would have been a little better, and probably be better if they just didn't do the Ghost City or trimmed it down or something. So it's like it kind of, that really comes down to how good the capital allocator is that's benefiting from this money printing. And I would say on average, or even the vast majority of the time, it tends to be less efficient when it's at that scale compared to what it is when it's more limited, and they have tighter trade-offs that they're trying to manage against.
Yeah, I'll just make a quick point if I can, Bob. I think that price signals are a public epistemic good. They tell us in a free market, in a fair market, in a transparent market, they tell us how much stuff is available and what people want, and they communicate that as an aggregate. And to Bob's comment earlier about central planners guessing the decisions about wheat, our decisions about what people want and what people need have to be informed by those prices. And if those prices are the result of distortions from various sources, could be money printing, it could be massive malinvestment on the part of a government, then we just don't have the truth about what people need and what people want. So we're unable to make wise decisions. And to Lyn's point, you have to be kind of an oracle to see what's coming, what people need, without the guidance of normal mechanisms of supply and demand. So I think that there's an open question of how much fluctuating money supply has distorted price signals and made us less able to judge what people need and what we have. Right? To me, that's an open question. But it's certainly greater than it would be if we had a sound money standard and we didn't have a government that funded itself on funny money.
So let's speculate a little bit. If the amount of debt is actually insurmountable and we cannot pay it off, at some point something goes wrong. Can a hard money standard ever be adopted, knowing that the people who run governments find it irresistible to print money? Can a Bitcoin standard, for instance, emerge?
All right, so I'll jump in, and I guess kind of the elephant in the room with this whole discussion is, well, gee, Murphy, if gold is so great, then how come the world went off of it? And even if they did do what you said, why wouldn't they just deviate from it again, right? And that is an issue. And I'm curious, if Lyn thinks that Bitcoin fixes this, as the slogan goes. Right, yeah. My guess going forward is it is going to be very difficult for major governments to get out of their current fiscal problem. And I don't predict it will happen. I think that you're going to see, formal and informal defaults. I think you're going to see a lot of countries just breaking up, whether de facto or literally secession movements, and just say, no, we're not paying that. We have nothing to do with the central government, that sort of thing. And then I think that, in practice, smaller groups might then just start using Bitcoin or perhaps other cryptocurrencies. And, that would be the way that they would sort of opt out of that system. So maybe some major government, like if I were running China and I wanted to get the world away from the dollar and into yuan, I might try to tie it to a basket of commodities or something. But again, ultimately the temptation would be to deviate from that once it became opportune to do so. So I think ultimately in the long run, only if households and corporations decide we can't trust money issued by governments, we got to go to market produced money, are you going to get out of this?
I agree with the caveat that I think there's technical tailwinds or headwinds against the probability of that happening. So to my earlier points, I think that we've been in an environment where there have been tremendous technical headwinds against people trying to adopt sound money, and the tailwinds have been on the side of government, on the ones that are able to basically capture the ledger that kind of fixes that transaction and settlement mismatch. It gives a lot of power, a giant like honeypot to those that can solve that and have the authority to say we're the only ones that can solve that. But in an environment where the technical winds shift, so the quote unquote Bitcoin fixes this, when you have a sound money that is both sound and fast, and then it achieves some scale, which I think we're still somewhat off from, even though it's this scale is not like true scale at the scales we're talking. But when you start adding like another zero to it or something, there's this viable alternative out there, and governments can resist with various pressures. But we have some examples already, which is like when the dollar encroaches into like a developing country, they would like to retain their money printer, but increasingly people are just like, I'm just not going to hold your currency and your bonds. I'm going to hold the dollar, or I'm going to hold gold or Bitcoin, whatever the case may be. And I think that can eventually happen to the apex predator. That can happen to the biggest countries too, if there's something like Bitcoin that comes along and says we literally can do everything the dollar can, but better. Gold couldn't quite make that argument because it says, well, we're sounder than the dollar, but we're slower. And the trade-off wasn't that big, because you say, okay, well, the U.S. money supply grows by 7%. If you hold a treasury bond, especially in kind of the decades ago, you might have gotten 4 or 5% interest, and then your kind of net debasement rate is not that different from, say, your typical gold debasement rate of on average 1.5% from new mining, and it's faster. So people are like, yeah, okay, I'll I'm not going to lose sleep over this too much. Whereas if you have something that's even slower in growth, and therefore it's attractive to hold, and it moves just as fast, that's, I think, can start pressuring these countries in a similar way that the dollar pressures developing countries. But I think it's not like a tomorrow thing. It's not a 5-year thing. I think it's to the extent that it's even going to be successful, I think it'll be a very long grind, in a similar way that network effects take a very long time to shift, is how I'd see it.
Yeah, I agree with Lyn, and Bob. I think it's going to be difficult to shift over to the dollar. I will give this simple reason. Governments can collect taxes in a money of their choosing, and they can choose a money that they can also print to receive taxes in. So they can guarantee demand for their money at some level. Of course, if something is around that's better, like a digital gold, better money in every other capacity other than paying your taxes, then most people will just hold that and then exchange for their tax payment once a year or whenever they have to pay taxes. But that, given that role of demand for fiat currency, I don't see why a government would ever give that up. Like, other things being equal, like you have the ability to demand payment in a currency that you print. Do you avail yourself of that, or do you just give that up? I think they avail themselves of that for a very, very long time. I like Bob's point about these debt bubbles bursting, and either we get defaults or we get massive money printing. That's Lyn's thing. There's no stopping this train. That's the train. It's not going to stop. And when that happens, then Bitcoin will be incredibly in demand, gold and other sound money. And then, people might pressure their government to accept it for taxes. They might just find it very inconvenient to hold Bitcoin and then in exchange for fiat currency. And they ultimately do control the government. But I think it would take something drastic to trigger that, given the what we talked about earlier, the kind of bag of chips next to you. I mean, like, why would you voluntarily give that up unless somebody's going to take it from you? You have the ability to demand people pay taxes in your currency. That's a tremendous amount of demand that you can take advantage of, and then you can print money when you need it for emergencies. I don't see that going away.
Yeah. And for the time being, Bitcoin allows individuals to opt out of the fiat system to the extent that they want to. And maybe that will come to an end someday if governments turn violent against it. But in the meantime, at least people have that option. Well, you guys, thank you very, very much. I really enjoyed it. I hope you did too.
No, yeah, this was great.
I appreciate the opportunity to play student and also devil's advocate.
I think this was a fun mix. Like I said, an economist, a philosopher, and an engineer walk into a conversation.
Yeah.
How's it going to go?
Yeah.
I think it's perfect. It's a fun set of people you brought together.
I appreciate it. I really thank you all for coming. And I look forward to talking to you soon.
Hey, if you like this clip, please hit the subscribe button. You might also want to check out some of the clips I've posted with my many other guests. My interviews all address the simple question, how screwed are we? We ask experts about the problems that make Americans so pessimistic today, but we also explore why there's never been a better time to have been born than today. Join us for perspective on today's challenges and opportunities.